Good morning all. Welcome back to next lecture. In the last lecture we discussed what actually mean by a two-sector model. Then we derived the income determination model mathematically when we have a simple two-sector economy along with number of numerical examples. I hope it was clear to you. Today we are going to continue our discussion regarding income determination models by incorporating or by imposing the lump sum taxes and proportional taxes into the simple two-sector economy without considering the government expenditure. So let's see what will be the income determination model by imposing lump sum tax and proportional taxes. See, a lump sum tax is a fixed amount of tax that is unrelated or it is independent of individuals' income level or economic activities. It is a fixed amount of tax which actually levied on the individual regardless of what is their level of income or their economic status. So in a simple two-sector model, we can say that it is y is equal to c plus I. We are going to introduce a lump sum tax which would be directly reduce disposable income of the household. So the reduction of disposable income, of course, which could lead to the reduction of level of income, and thereby there is a decrease in the consumption because household have less income available for the consumption purpose right now. So that's why these taxes are considered as a generally regressive in nature because they are imposed on all individual without considering what is their level of income. So therefore the burden of these taxes falls more on the lower income level of people or lower income level of people than the rich people. Let's see, we are going to introduce lump sum tax here. See, our economy two-sector model, we are already said that y is equal to c plus I, that is income is equal to consumption plus investment. Then where c is equal to consumption is equal to c0 plus byd, where c0 we are already said that it is an autonomous consumption and b is the marginal propensity to consume and yd is nothing but it is showing your disposable income. So here the c is equal to c0 plus byd. Then what actually the disposable income means? See, we are going to incorporate the lump sum tax here, that is yd, that is your disposable income is equal to y minus t, that is income minus tax, and I is equal to, we are denoting it is autonomous investment, that is I0. Then we are going to substitute C, YD and I0 on the level of income, that is Y is equal to C plus I equation. So here Y is equal to, instead of C I am substituting here C0 plus BYD, C0 plus BYD plus I0. Then we know what actually YD is, it is disposable income. We are going to rewrite yd by using y minus t. So it will become, see, y is equal to c0 plus b into, instead of yd I am putting here y minus t plus I0. So y is equal to here, by opening the bracket and multiplying b with y and minus t, it will become y is equal to c0 plus by minus bt plus I0. And here I am taking the y term by into the left hand side of the equation. So I am putting minus by, which is equal to what is remaining here, c0 minus bt plus I0, that is investment. So here y and y is common. So I am taking y into the outside. So what is remaining here? 1 minus b, which is equal to c0 minus bt plus I0. Then I am taking the 1 minus b into the right hand side of the equation, so it will goes to the denominator side. So it is equal to 1 by 1 minus b into c0 minus bt plus I0. And we can say that y is equal to by multiplying this term with 1 by 1 minus b, this term will goes to the numerator side. So C0 minus Bt plus I0 divided by 1 minus b. See, actually this equation shows that the equilibrium level of national income in terms of exogenous factors. See, what are the exogenous factors which are influencing the level of income here? See, autonomous consumption, that is C0, then Bt, which is nothing but it is the tax, as well as we have an autonomous investment. So actually it demonstrates that how changes in these variables can affect the equilibrium level of income in an economy. Introducing lump sum tax, see, which will alter the disposable income available to the household, which in turn affect the consumption behavior and its overall the aggregate demand in the economy. See here, 1 by 1 minus b, 1 by 1 minus b, it is nothing but it is the multiplier, as we are already derived earlier as well in the case of a two-sector economy, where also we derived the multiplier value is equal to 1 by 1 minus b, which shows that imposition of lump sum tax does not directly affect, the marginal propensity to consume or marginal propensity to save. Therefore, it does not directly the multiplier effect in the economy. That means the imposition of lump sum tax does not affect the multiplier, but of course it will reduce your disposable income of the people, which leads to the lowering the consumption spending of the people, since consumption is a component of the aggregate demand. A decreasing consumption will leads to the decreasing in the overall aggregate demand in an economy. Now let us consider one example. See, consumption is equal to 100 plus 0.6y and investment is given 40. Find the equilibrium level of income, and what happened the level of income consumption if government imposed a lump sum tax of 50 rupees. Now see here, first we will find the equilibrium level of income before imposition of lump sum tax of 50 rupees. So we have the model two-sector economy, which is equal to C plus I, consumption is given which is 100 plus 0.6y, investment is equal to 40. So with this given information, we can find the equilibrium level of income. So we can substitute y is equal to C, which is 100 plus 0.6y plus 40, which is equal to, taking this 0.6y into the left hand side of the equation, it will become minus. So y minus 0.6, y is equal to 100 plus 40, which is equal to 140. So here y and y is common, so I am taking into the outside. Then what is remaining? 1 minus 0.6, which is equal to 140. Then 1 minus 0.6, which is equal to 0.4, which is equal to 140. And dividing the both side of the equation by using 0.4, then we will get y is equal to 140 divided by 0.40, which is equal to 350. So what it is showing, it is the level of income when before imposition of the lump sum tax. Now look at the level of consumption. See, the level of consumption, that is consumption function, which is already given, that is 100 plus 0.6y, and we want to find the consumption level as well by substituting the value of y is equal to 350 on here. So it will become 100 plus 0.6 into 350, which is equal to 310. So the consumption before imposition of the lump sum tax is equal to 50. The level of income before imposition of the tax is 350. Now we are going to add up, what happen if we are going to impose the lump sum tax. See, now we are going to impose the lump sum tax here. Y is equal to C plus I, and the consumption function is given. And here we are putting it is YD, disposable income. And YD we are already said that it is the difference between income and tax, that is Y minus T. Then T is equal to 50, that is tax is given, that is lump sum tax of 50. So T is equal to 50 here. Then I0, that is autonomous investment, which is 40. Now we are going to substitute all these things in the income equation, that is y is equal to C0 plus BYD plus I0. So this function is given here, which is 100 plus 0.6 yd plus 40. Now we know yd, what actually mean by yd? See, it is y minus t. So I am putting it is y minus t instead of yd. And what is t, which is already given here? T is equal to 50. So y is equal to 100 plus 0.6 y minus 50 plus 40. Now I am opening this particular bracket by multiplying with 0.6. It will become 100 plus 0.6 y minus 0.6 into minus 50, which is equal to minus 30, then plus 40. So here I am taking the 0.6 y into the left side of the equation. It will become y minus 0.6 y, which is equal to 100 plus 140 minus 30, which is equal to 110. See here, y term is common here, so I am putting into the outside, and what is remaining here? 1 minus 0.6, which is equal to 110. Now this term will become 0.4, y into 0.4, which is equal to 110. Now substituting the both side of the equation by 0.4, then it will become 110 divided by 0.4, which is equal to 275. Then after getting the equilibrium level of income, this is the level of equilibrium after the imposition of tax, we will also calculate the consumption level. See, the consumption function which is given, that is 100 plus 0.6 yd, where see it is 100 plus 0.6 yd, where yd is equal to 275. So I am putting here yd, that is 275 minus, see yd is equal to y minus t. So here it is y, which is equal to 275 minus 50. So because lump sum tax is directly reducing from your level of income. So if you go for simplifying it, then it is 100 plus 165 minus 50 here, then which is equal to 235, which is equal to 235. Now see, as earlier the income was 350. Now after the imposition of lump sum tax, your level of income is decreased to 275. And what happened to the consumption? Earlier the consumption was 310, and right now the consumption is only 235. So this is the example regarding what happen if government is going to impose the lump sum tax of rupee 50. Now consider the another example in the same format, that is consumption function is given, autonomous investment is also given, and we want to find out the level of income and consumption. Then government is imposing a lump sum tax of 100 rupees, and we want to find out what is the effect of the imposition of lump sum tax on the consumption and the level of income. See, y is equal to c plus I, consumption function is given, it is 80 plus 0.75 y, I0 which is equal to 50, then we can directly substitute the value, these functions in the equation, that is y is equal to c plus I. We are going to calculate the level of income before imposition of lump sum tax, so that the effect can be captured very easily. See here, the consumption function which is 80 plus 0.75 y plus 50, that is autonomous investment is 50. Taking the y term into the left hand side of the equation, so y minus 0.75 y, which is equal to 130, which is 80 plus 50, which is 130. Y is common here, so I am taking into the outside. So it will become 1 minus 0.75 is equal to 130. It will become 1 minus 0.75 will become 0.25 y, which is equal to 130. So dividing the both side of the equation by 0.25, it will become, see, 130 divided by 0.25, which is equal to 520. So before the imposition of tax, your level of income is equal to 520. Now what is the level of consumption? The consumption function is already given, that is 80 plus 0.75 y. We are going to substitute here the y term. So here it is 0.75 into, it is 520 is your level of income. So C is equal to 80 plus 390, and C, if you go for simplifying it, the consumption is equal to 470. Now this is the consumption level. Now let us see what happen if the government is going to impose the lump sum tax of 100 rupees. Y is equal to C plus I, consumption function is given, investment function is also given. Now T is equal to 100, that is tax is equal to 100. Then yd is equal to, see, our equation will become c plus byd, which is equal to I. So here I am going to substitute the consumption function and investment function. So it is equal to 80 plus 0.75 YD. It is YD plus 50. So instead of YD I am going to substitute it is Y minus T. So Y minus T, here it is 100. So tax is imposing, it is 100 rupees here. So we can simplify it by multiplying the 0.75 with Y and minus 100. So it will become 0.75 Y minus 75 plus 50. So it will become, see I am going to take the 0.75 Y into the left hand side of the equation. So it will become Y minus 0.75 Y, which is equal to 80 minus 75 plus 50. So Y term is common here. I am taking into the outside 1 minus 0.75, which is equal to 55. 0.25 Y, which is equal to 55, dividing the both side of the equation by 0.25, then Y is equal to 55 divided by 0.25, which is equal to 220. So this is the level of income after the imposition of tax. Now consider the level of consumption. See, level of consumption, now we are going to substitute in terms of Y, which is equal to 220. So it will become, if you go for simplifying it, the consumption is equal to 80 plus 165, which is equal to 245. Now after the imposition of lump sum tax, see what happened? Your level of income, the earlier it was 520. Now the level of income is only 220. And what about the consumption? Earlier consumption was 470, that is before imposition of lump sum tax. Your level of consumption was 470. Right now your level of income is reduced to 245. So this is the effect of imposition of lump sum tax. It cannot affect the multiplier, but at the same time it will affect your disposable income, and thereby your level of income and your consumption will be decreased in an economy. Now we are going to introduce another type of tax, which is known as proportional taxes instead of lump sum tax. See, we will look at what actually the proportional tax means. See, the proportional tax, where the tax rate is proportion to your level of income. It is proportion to your level of income, or the disposable income which is affected by the tax. So everyone pay the same percentage of their income as a tax. So it is differ from lump sum tax, which is based upon the fixed amount. Everybody should pay a fixed amount of money in the case of lump sum tax without considering what is your level of income. So it will badly the poor people rather than the rich people. But here the proportional tax is based upon the percentage of their income. So lump sum tax is actually imposing the same tax burden for all the taxpayers, regardless what is their level of income. But in the case of a proportional taxes, we are imposing a tax rate which is proportional to the level of income. So I hope you understood the differences between lump sum tax and the proportional tax. For example, a flat income tax of 20% means that all the taxpayers, regardless of income, pay 20% of their income as a tax. So here we can say that the tax is depending upon is your level of income. So here tax is equal to T0 plus Ty, which means that this equation actually says that the proportional tax system, where the total tax, which is the function of both fixed component, this is fixed component of the tax, that is T0, and the proportion of the national income which is paid in the form of a tax. So it is in proportion to your level of income. So here this component actually shows that this is your total tax paid by the individual. T0 is the fixed component of your tax, which actually representing it is the lump sum tax, and which everybody should pay regardless their level of income. And T is the proportion of tax rate, proportion, or it is the tax rate representing the percentage of income that individual pay in the form of a tax. So thus the tax burden of the proportional tax, which varies on the basis of your level of income, because it is fixed or it is imposed on the proportion to your level of income. So now let us see what happen if we are going to impose the proportional tax. See, we are considering the two sector economy. Y is equal to C plus I, C is equal to C0 plus BYD, where YD is nothing but it is your disposable income. So YD, which is Y minus T, which is tax, income minus tax, but tax is again depending upon the level of income. So it is T0 plus Ty. So it is the component of tax which is fixed, which is generally considered as a lump sum tax, and Ty, which is the proportion of the taxes which is entirely depending upon your level of income, and I is equal to your autonomous investment. Now we are going to substitute all these functions into the equation, that is Y is equal to C plus I, where C is equal to C0 plus BYD plus I0. So instead of YD, now I am imposing Y minus T. See, it is B into Y minus T plus I0. Now what is T? T is also function of, see, T0 plus Ty. I am writing here in the bracket instead of T. See, it is T0 plus Ty. So our function will become, see, Y is equal to C0 plus B into Y minus T0 plus Ty plus I0. So Y is equal to, now I am opening this particular small bracket here. So it will become minus T0 and minus Ty plus I0. And thereby, see, I am going to multiply with B here also, so that we can open this bracket as well. So Y is equal to C0 plus B into Y, By, minus B into T0, which is minus T0, then minus B into minus Ty, which is equal to Bty plus I0. Now I am going to take the Y terms, By minus Bty, into the left side of the equation. So it will become Y minus By, here it is minus, so it will become plus Bty, which is equal to what is remaining here? It is C0. Then here it is minus Bt0, then I0. So here Y is common, so I am taking Y term into the outside. What is remaining here? 1 minus B plus Bt, which is equal to C0 plus I0 minus Bt0. So now I am going to take this 1 minus B plus Bt into the right side of the equation, so it will goes to the denominator side. So it will become 1 by 1 minus B plus Bt into C0 plus I0 minus Bt0, and multiplying these two terms, it will become C0 I plus I0 minus Bt0 will goes to the numerator side, divided by 1 minus B plus Bt. So what actually showing here? See, here it represents the equilibrium level of income. This is the equilibrium level of income in a two sector economy on the basis of, or in a, with the proportional tax system that entirely depending upon your level of income. So it consider the impact of marginal propensity to consume, that is B, and the proportional tax rate on a multiplier effect. So this is the result which will leads to the reduction in the size of multiplier. See what actually the multiplier here it is 1 by 1 minus B plus Bt. So this is the multiplier after imposition of the proportional taxation. And this multiplier, it is nothing but it is the modified multiplier which incorporate the effect of proportional taxes on disposable income and adjust the multiplier accordingly. So it shows that how changes in the level of investment or changes in the consumption will actually affect on the level of income after considering, it is marginal propensity to consume and the tax rate. So the size of the reduction in the multiplier, of course the multiplier size will be reduced after the imposition of the proportional taxation as against the lump sum taxation. In the case of lump sum tax, which cannot affect the multiplier, but in the case of proportional taxes, it is affecting the multiplier, and accordingly the size of multiplier will be reduced. And the size of multiplier entirely depending upon the magnitude of these two terms, that is, one is marginal propensity to consume and another one is magnitude of the tax rate. Now we are going to consider some numerical example. See, consumption function is given, it is 85 plus 0.75 YD, and investment function is given, and YD, of course, it is equal to Y minus T, and T is equal to 20 plus 0.25. I am writing here Y is equal to C plus I, consumption function is given, The income is already given here YD, that is your disposable income is equal to your income minus taxation. T is already given here, it is 20 plus 0.25, which means that your level of income is also based upon your level of, your level of taxation is also based upon your level of income. I, investment is given, which is equal to 30. Now we are substituting all these into the level of income, that is Y is equal to consumption, which is 85 plus 0.75 YD plus 30. You know YD, which is equal to Y minus T. So instead of YD, I am writing here it is Y minus T plus 30. So 85 plus 0.75 Y, what is actually T? T is equal to 20 plus 0.25 Y plus 30. Now I am going to open the small bracket here. So it will become, see, Y minus 20 minus 0.2 Y plus 30. Then again I am going to multiply 0.75 with all these terms. It will become Y is equal to 85 plus 0.75 Y minus 20 into 0.75, which is equal to 15 minus 0.15 Y plus 30. So now I am going to take the Y terms into the left side of the equation. So it will become Y minus 0.75 Y minus 0.15 Y will become plus 0.15 Y, which is equal to what is remaining here? 85 minus 15 plus 30. So here Y is common in three terms. So I am taking Y into the outside. Then what is remaining here? 1 minus 0.75 plus 0.15, which is equal to 100. So we can solve it. So Y is equal to, it is 0.4. Y into 0.4, which is equal to 100, dividing the both side of the equation here by 0.4, Y is equal to 100 divided by 0.4, which is equal to 250. So this is the level of income after imposition of the proportional taxation. Now let us see another example. See here, what is the effect of the proportional taxes on multiplier? The same example I am using here, but we are going to consider the effect of proportional taxes on the size of multiplier. See, without considering the proportional taxes, what is the multiplier? Which is equal to 1 by 1 minus B. So 1 by 1 minus B is the multiplier if you are not going to consider the proportional taxes. So B is equal to, it is given in the consumption function, which is 0.75. So it is equal to 1 by 1 minus, instead of B, I am putting it is MPC, that is 0.75, which is equal to 1 by 1 minus 0.75, which is equal to 0.25, which is equal to 4. So this is the size of multiplier before introduction of the proportional taxation. Now let us look after the introduction of the proportional taxes, what is the size of multiplier, and we are already derived what actually the multiplier it is, 1 by 1 minus B plus BT. So this multiplier is derived after imposition of the proportional taxation, and which we know it is entirely depending upon your level of income. So we are putting here 1 by 1 minus B MPC, which is equal to 0.75 plus B, that is again it is 0.75 into T, which is equal to 0.2 here. It is this T showing that it is the proportion of your income which you are going to pay in the form of tax. So it is here, it is 0.2. So if you simplify it, then it will give 1 by 0.25 plus 0.5, which is equal to 1 by 0.4, which is 2.5. So it represents, adjusted multiplier effect, when there is a proportional tax is imposed. See here, the multiplier value is equal to 2.5. Earlier, the size of multiplier was 4. Before introduction of proportional taxation, but after introduction of proportional taxation, our size of multiplier is decreased. So the multiplier effect is lower in the presence of proportional taxation, indicating that the tax dampen the overall impact of changes in the autonomous spending on the equilibrium level of income. So let me conclude here. Today we have discussed what is the effect of imposition of lump sum taxes and proportional taxes on national income and the consumption and the size of multiplier along with number of numerical examples. I hope it was clear to you. In the next lecture, we will continue the discussion regarding the national income determination model. by incorporating the government sector into the system, which is popularly known as three-sector economy. Thereafter, we will introduce the external sector as well, so that our economy will become, an open sector economy. So we will see in the next lecture. Thank you.